I'm now going to shift into the banking and try and get reactions from the top financiers in the country. Mr. S.S. Mundra of Union Bank is joining us. Mr. Vaidyanathan of Future Capital is joining us as well. But let me get to Mr. Mundra first. Mr. Mundra, very good afternoon to you, sir. I want to start with the issue of higher provisioning on restructured assets, sir. What is going to be the impact firstly for Union Bank from 2 to 2.75% is what the RBI has done?
Yeah, obviously there is going to be some impact, but the impact is not something which will be very big. Our assessment is looking to our restructured asset portfolio. The impact may be something like 70 to 75 crores rupees of additional provisioning which will be required to be done. As a one-time movement, when you move from 2 to 2.75, and then going forward it is on the incremental portion. So something which can very well be done within the existing finances.
Okay, so you said the impact, sir, say on profits is going to be what? Quantify in percentage terms. Can you be quantified for us, sir?
Pardon?
So in percentage terms, the impact on FY13 EPS would be around 5-ish% for you, for Union Bank?
No, it can't be 5%. No, as I said, the net impact, the additional incremental requirement which is coming 70 to 75 crore. So I would say it will be something like around 2% or so by the normal profitability projections.
Okay, 2% or so by normal profitability projections. So the other thing that they have done is that they have told banks that they have to be very strictly adhering to the information sharing guidelines, particularly on credit derivatives, on unhedged forex exposure. And they're going as far as to say that if banks don't adhere to it, the RBI will impose penalties. So is it your understanding that that is something that's going under the radar? It's not being properly, information is not being shared, is not being properly reported, and hence that NPA risk has become more for a lot of corporates?
No, I think is a very valid point. What I would like to say that RBI has further reiterated what should be generally which is an established practice in the banking and which should be strictly observed. Having said that, let me actually tell you how it has evolved. If you look at the past few years, the banking system has got a multiple model of lending, which is there is a consortium advance, there is a syndicated facility, and there is multiple banking. Now, over a period, within this various frameworks, somewhere the information sharing is, I must admit, has diluted to some extent. If had it been only a consortium approach and everyone is lending within the consortium, then information sharing becomes an automatic process for there is a structure. But when there is a consortium lending, then there is somewhat lending outside the consortium. In some other banks, other lending, there is no formal consortium, but there is a multiple banking. These kind of issues are there. I would like to say that not only about the unhedged forex exposure or the credit derivatives, but the entire entire area of credit needs to be shared. And I think, of course, we have yet to go into the detail as to what RBI has mentioned about it. But I think what will be very vital, that there has to be a very formal system of this information sharing, and it should be very clear that who should initiate the process, where it should be pooled, and how it should be transmitted. In consortium arrangement, it is fairly clear because there is a consortium leader, and that is where the information can always be pooled and shared. I think we have to evolve a similar system in case of multiple banking or the loans which are done under the syndication arrangement. So I think it is a very, very valid point, and it is something which will be very, very beneficial for the banking system itself.
Okay, so last question to you. The CRR cut 25 basis points, but a slight guidance of a repo rate cut possibility perhaps in January. Will that allow banks such as yours to cut interest rates further, sir?
See, if you look at it continuously in the past with the few policy announcement and the CRR raising coming, it has certainly given the banks maneuverability to look at the spread which we charge to the borrowers, and I think consistently there had been a reduction in case of our bank as well as in the banking system to the which is passed on to the borrowers. As far as the overall the base rate and other things, I think we will make a careful assessment, and also by the future guidance which is given by the RBI, we will once again, like we do at every policy pronouncement, look at all the components in our ALCO and see that whether we can continue to provide the benefit of spreads to the borrower, and also look at all the components of our lending rate. And of course, while doing all that, we would have to be mindful, every bank will have to be mindful that we are also in a position to provide a real return, in terms of rate of interest to the depositors. So I think as a banker we have to balance between the two.
All right, let's see how it plays out. Thanks so much, Mr. Mundra. Important reactions there, particularly on the restructured assets issue. I'm going to Mr. Vaidyanathan. He's been waiting. Mr. Vaidyanathan, very good afternoon to you, sir. I apologize to have kept you waiting, but wanted to get to you back on the macro picture. How do you see this policy? I think I've got some slightly divergent views. There are people who are saying that this was finely balanced, others who would have liked to see more in terms of rate action from the RBI. What about you, sir?
Well, while the RBI has been shy of touching the policy rates for the last many policies, fact is that the CRR cut in its own way has already reduced the interest rates in the system, and you can see over the last 6 months there are many offers going for the banking system on home loans even at 10.25% and so on. So rates of interest have already come down. So the larger improvement in sentiment, so to say, which is hinged on the twin acts of both the amount of liquidity as well as interest rates, is already being affected. I think it's very finely managed in the sense of signaling on inflationary expectations are still being maintained cautiously, but the same time relief is being provided to the financial markets at this point of time.
So what are the indications that you're picking up from the ground in terms of where we stand on growth? On the one hand, we are hearing that retail credit demand, particularly in the festive season, has been pretty strong, indicating that maybe you are seeing some stability at the consumer end. On the industrial side, there are early indications that maybe things could pick up. So are there indications, and is the RBI justified in saying that maybe growth is bottomed and we need to keep a focus on inflation, because there we don't know whether it's topped out?
Well, the RBI, as you can see, is quite concerned about growth and are now beginning to become significantly concerned about growth. And I think also credit growth is a concern. What is really happening is that the banking system and the financial system is gradually moving away from lending to corporates, I would say. Whether they say it explicitly or not, I think either credit proposals are not coming or bankers are shy of lending to corporates because of the overall economic environment, and moving more and more towards retail. And that is where the interest rate drop is definitely affecting. Is probably improving. But having said that, I must say that the consumption demand, which is one of the key pillars of the growth of the economy, is definitely falling. You see what's happening to Hindustan Lever's numbers that came about, Bajaj numbers, Hero Motors numbers. Clearly, there is a slowdown in terms of growth, or slowdown in absolute numbers itself over the previous year. So therefore, I do not think we should be taking consumption for granted, and therefore there is an impact on consumption already. But having said that, the recent liquidity injection and the reduction of rates have in a way, let me say, the lightning rod is beginning to show some initial improvement on demand. But I must say it must take another 6 months for demand to come up on the basis of sentiment.
Okay, got that, sir. I also want to get your thoughts on this entire asset quality issue, sir. How do you see what's happening on the asset quality side, this rush of restructuring continuing? The RBI is taking case with banks, on information sharing, but also raising provisioning needs and restructured assets. Do you see asset quality continuing to be a concern in the next few quarters, and is it normal? A lot of people have suggested that it's normal in a downturn, although one could argue that the pace at which it's continuing may not be normal.
Well, the pace of continuation of the deterioration is not exactly normal, because specifically on those select sectors, let us say airlines and power or textiles or even iron and steel, there is an issue, and I think those can be arrested only when genuinely the economic activity picks up. So I think that all eyes should be on growth of the economic activity and these things will stabilize as and when the economy picks up. But really on the retail side, there is no issue. I think credit sharing, at least on the retail side, is really quite good over the last few years, thanks to CIBIL and a few other credit bureaus. And I think on the retail side, there is really no issue at all. Wholesale, select pockets is an issue, but that will really come back only when the economy comes back. Mere restructuring is really not going to solve the problem.
All right, Mr. Vaidyanathan, I'll leave it there. Thank you so much, sir. Appreciate you joining us today with your thoughts on the macro picture and some individual banking sector issues. I'm now going to flip over into the market reaction.